Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes.
Okay, guys, today we have on Felix from Forward Guidance, which you guys probably know as one of the few podcasts, I would say, that is crypto or crypto adjacent, but has actually truly broken out into the mainstream. And Felix is one of the thought leaders on crypto Twitter, particularly surrounding macro and real economics, not the fake economics that we typically deal with. So happy to have him on. We're going to get an overview of hyper gambling our way to wealth. But Felix, please introduce yourself. Maybe just tell us a little bit about what you do.
Yeah, first off, just want to say thanks for having me. Big fan of the show. Big fan of what you do. Always have very pragmatic takes with a hint of sarcasm, which aligns really closely to how I view the world. So really love that and appreciate that. Yeah, I run the Forward Guidance podcast, which is part of the Blockworks network. Mostly macro focused, but also a lot of crypto as well. I always describe the way I look at markets and the way I operate is just like this huge barbell where it's just like fully in the trenches in the crypto world, like, just trying new things as they emerge and just like in there, shit posting with everybody. And then also very deep on the macro world, which is sort of where I made a bit of a network for myself as well and try to see where the two worlds intersect and collide, which seems to be the trend these days where, I've just been hearing from so many people that were, TradFi folks that hated crypto for years. And then the last year or so have really started to come around. So it's been a really interesting journey.
Yeah. So I don't know if I don't know personally, but what was your original background? Like, were you trading? Were you working? I don't know. Like, were you at a hedge fund or something? I get the feeling that you were working in real finance prior to coming to our side and doing macro stuff for us, but I don't know exactly like your background. So just like a little tidbit would be great.
Yeah. So, I mean, part of that is true. Part of that isn't. I've had actually a really weird career journey. So I studied business in my undergrad. And then I sort of fell into actually marketing and advertising for a lot of years and content and that whole thing. So I worked in agencies for quite a few years, like 6 to 8 years there, was doing a lot of just like strategic consulting, ideation or like marketing and branding campaigns and that sort of thing. Running big like social media accounts for big brands and that sort of thing, mostly focused actually on like the outdoor industry. So like, I don't know, Arc'teryx, for example, was like a client of mine for a while. So yeah, so that sort of thing. And then over the years, I don't know if I fully got bored of that world, but I started to get a lot more enamored with the finance world overall. So I started my journey more so as a value investor. So for those that didn't really look into that world and just headed straight for the shitcoin trenches, it's really that like classic like Warren Buffett approach to investing where you are focused on trying to value a company through like a DCF format or whatever, just trying to get the intrinsic value of the company and then deciding like, is this a decent price that I want to own for it and own it for a long time? And I was doing that for myself for a while and just became very disenfranchised with that style of investing. It felt very broken in this world of the internet, in this world of, we'll get into it when we talk about macro, but I fundamentally believe that like interest rates are basically manipulated in this world. You can look at like things like QE and other stuff we can get into, but effectively what that does is it manipulates the discount rate that you value these companies on effectively. So, if your discount rate is wrong, that starts to throw off a lot of weird, wonky secondary effects in terms of how you value these companies and that sort of thing. So that shifted me more so to get into the macro world, which has been my main thing for, 8 years or so now. Been really focused on that world. And that's actually how I ended up in crypto. So I went through this journey of trying to pivot my career. So I was starting to just, write my thoughts about macro. Eventually I got picked up and started working for Reflexivity Research, which is like this research firm that Will Clemente and Anthony Pompliano started. So they're doing crypto research, but I was doing all the macro work there. At the same time, I was pursuing my CFA. I did the level 1 and then I didn't go any further. So just to try to formalize a bit of that pivot, at least from like a resume perspective. So I was there for a couple of years. It was really great. And then eventually I ended up as a guest representing Reflexivity on a Blockworks podcast where like Mike Ippolito interviewed me and everything, and really enjoyed it. I've always had a really high regard for Mike and Jason and the Blockworks team. So at one point, I just reached out and I was like, hey, look, like, are you guys hiring? What are you hiring for? I sort of live in this weird barbell world of macro and crypto and how they both collide. And Mike was like, you want to be a podcast host? Like, I'm not a podcast host. Like, are you kidding me? That sounds insane. But again, like building off my previous work experience, I knew a lot about content and content strategy and branding and marketing and that sort of thing. And so it was just this interesting cross current of a lot of different parts of my career journey that all came together. And so now I've become this podcast host for this macro podcast, and it's been a really interesting journey.
Yeah. Okay, great. That was a perfect amount of context here. Okay, so let's just like hop in, I guess, to macro stuff. I hope I can ask profound enough questions, maybe. Where are we like in the cycle? And you can, I just run with that and then I'll pry more. But like, give us your overarching views right now. I do listen to Forward Guidance off and on, so like I have some context myself. But like what are we looking at right now?
This regime shift has caught a lot of the macro OGs off guard. So basically, nonstop since like 2020, end of 2021, we've heard calls for a recession to happen. Like it feels like every 4 to 6 months, you just like at one point it was like 100% of economists were calling for a recession at one point in 2022. And you saw the Federal Reserve is jacking rates up to like the fastest rate hiking cycle in history. It made a lot of sense for there to be a recession like when you just move rates that quickly, it's like, okay, this is bound to happen. And it never did happen. And there's been many calls since for, even as far as like April. Obviously, a lot of that was dependent on the tariffs and if they were going to come in at the levels that were being expected at the time. And obviously, there was a pivot there. But regardless, there's been a lot of misconceptions around this regime shift. So the easiest way to describe this regime shift is this transition from monetary dominance to fiscal dominance. And these are words that, you probably see thrown around a lot on the timeline. So I'll try to sharpen it a little bit, but we've been in a monetary dominance world for many decades now. This is the world that, most traditional TradFi market pros think of and are used to, which is, okay, the Fed increases and decreases the federal funds rate, and that has a pretty quick effect on the economy. And they can just basically manage employment and inflation from that regard. And what's happened is a few different things have started to change. So one is that we've seen a change in how they execute on monetary policy. So as opposed to that world of like, let's just call it the 1990s, it's probably like maybe the golden age of monetary dominance, where it was very clear cut how they're operating. And then we've moved into this world where there's a focus on different tools. So Forward Guidance, which, hence the name of the show, is about the Fed trying to basically project and forecast their plans for rate cuts. And the reason they do that is because there's certain, more esoteric parts of the macro world of macro markets that can price that in right away, like SOFR futures. So they can actually like deploy monetary policy without actually deciding to change the rate just by saying things. So there's been that. There's been this refocus towards like balance sheet management, which has basically caused this huge cottage industry of like, you hear like net liquidity and that sort of thing, which is like tracking the Fed balance sheet and the different flows. And then the biggest regime shift now is we're running huge fiscal deficits with a very highly indebted economy. So there's a couple things there. The one is that the best way to think about like this, measuring this fiscal deficit is just looking at like as a percentage of GDP. And so we're running a 7% of GDP fiscal deficit during a time where like employment's at like max employment, as economists say. Like basically like the economy is doing great, but we're running a 7% of GDP deficit. If you look at history, that level of a deficit is typically something we do during a recession. So we're basically running like a fiscal deficit of a size that we would be doing during a recession to get the economy going again, but we're like ripping. And then the second order effect of that is that paired with the interest rate hikes that we've actually seen of going up to 5%, because of how indebted the economy is, like, just think about like a debt to GDP ratio type of thing. You hear this a lot, like we're above 100%. And so because of that, because there's so much debt out there in the system, when interest rates go up, that's interest income to the owners of that debt. So like, T-bills, money market funds, the whole like T-bill and chill thing that was popular like in 2023 and that sort of thing. So basically that's increasing the interest income. And the only reason that it hasn't actually slowed the economy is because like the liability side of these individuals. So from like an individual perspective, their houses, right? Like US mortgages are 30 years and fixed. So all these people that got into like a 2% mortgage in 2021, they can sit on it for 30 years. And the same on like companies have done this too, where they've like termed out their debt. So they've issued like a lot of long-term debt that doesn't have to change even if interest rates go up on a short-term basis. So you have this crazy situation where as we increase interest rates, their incomes go up and their net wealth goes up, but their liabilities don't increase as well. So this combination of this high fiscal deficit with this interest income and the fact that the liabilities are fixed has created this super confusing world that has thrown off a lot of people. And that's why, like, even though since 2022, we've seen interest rates surge, we have Bitcoin at all-time high. We have NASDAQ at all-time high. We have like all these things popping off. And so it's confused a lot of people. So where are we at now in terms of that cycle is I think it's going to accelerate further. So we had like the big, beautiful bill that came out, and that's going to push deficits potentially to like almost 8%. And part of that will be offset by some like tariff revenue, which is basically like a tax. So part of that will be offset, but regardless, like the direction is for this to accelerate. And so a lot of people have not wrapped their heads around this new regime. And this has basically caused this like distinction between the people that keep saying like, oh, like stocks are overvalued, crypto's popping off, like the economy is probably going to slow and that sort of thing. And these people who have just been like long risk and doing pretty well. So yeah, I think that's going to accelerate from here basically. Okay.
That's a great overview. Okay. So like, I guess my second question would be, what are in your mind, like what are the implications of this? Like, you're talking about Bitcoin ripping to all-time highs despite high interest rates. Like, it seems that there was this moment in time, right? Like during COVID, we're all like, of course it's risk on, right? Like we're all at home gambling generally. And then like a lot of this has persisted or ramped up in different verticals, like longer than we would have expected. So like, this is all sort of in line with what you're saying. Give us the 5-10 year implications of this. Like, I know I've obviously I listen to your podcast, but just, yeah, like, you can run with that.
So two big themes there. The first one is that the big constraint on these fiscal deficits increasing is basically inflation. I've been starting to convince people of this idea that what we're doing now, this format that I just described, is actually like more powerful than QE. So you have the QE monkeys that are always saying like, we need QE for also go up. And I've kind of pretty aggressively faded that idea. And that's because this is like direct money creation as opposed to QE, which we don't need to get into the semantics too much, but it's just like a swap of like different financial assets. It's like a swap for like a bond for a central bank reserve. So it sort of stays isolated within the financial system. But this regime that we're in now is much more inflationary, especially when you decide that fiscal deficit that you're running, you decide to issue a lot more bills. So like short-term treasuries versus long-term treasuries. When you issue short-term treasuries, that acts basically like cash with a yield effectively. Like the easy way to think about it is just like a yield-bearing stablecoin. Like that's what they're creating when they're creating bills for the crypto natives. So as we create more of that, the cost is inflation, basically. So that's going to be the theme, is like secularly higher inflation as we continue down this route. And really like the only constraining factors for this path to stop is either people don't want to own long-term bonds because higher inflation decreases the prices of bonds. Basically, we don't need to get too much into the bond math, but it's not great for bondholders effectively. And so eventually, if we get to this point of people just being fed up with owning these bonds that are just getting devalued because we have higher inflation, you could see them start to sell them a lot, which would make yields go higher. And that could get high enough to the point where it creates this like debt spiral effectively, where like higher yields means that the deficit goes up, which means that they have to issue more debt to cover the deficit, which means more bonds, which means more bonds being sold into a market where like nobody wants to own the bonds and that sort of thing. So basically, the constraints are inflation increasing, and then long-term yields increasing associated with that. And then also like societal impacts as well, like wealth inequality. Like as long-term bond yields go higher, mortgage rates go higher. So more and more people are going to not be able to own houses and that sort of thing. So I think the right way to think about this is, people have been calling for like a debt default or crash of some sort, thinking like, look at debt to GDP, like why is it continuing? Like this has to end at some point soon. And yes, but it's a lot more sustainable, basically, really until you get to a point where politicians, like this is a politics decision. It's not like a Federal Reserve decision. It has to get so bad to the point where voters are fed up and want to vote these people out because they're, just getting destroyed by inflation and they don't own any assets, and wealth inequality gets so bad. So yeah, the constraints for how long this goes are really, it's mostly societal. And so this is a world where it starts to make sense. Like if you just think of like that traditional 60-40 portfolio of like 60% stocks, 40% bonds, if 40% of that bag is just like you're not going to be making money in real terms or nominal terms for like a lot of years now. And like all these boomers that are retiring are going to be probably even more like 70% bonds. If they get to this like, oh shit moment where they're like, my retirement situation is getting a lot more constrained because like 7% of my portfolio is just like in the dumps, they're going to need to start to diversify. So that's why you've seen like gold do so well. And then coincidentally, that's why we've seen Bitcoin do so well. So I think the big trend for the next 10 years is within this regime is going to be this diversification of like very, very sticky boomer money, going into gold, going into Bitcoin, going into probably other crypto assets as you get further out the risk curve, and also commodities as well. But basically like alternative assets. So yeah, the big constraint though is really inflation and just like how bad it needs to get until people get fed up.
What do you make of, this is like a little bit more, current events focused, but what do you make of the firing or alleged attempt to fire Jerome Powell? And the reason I ask, so I'll give a little bit of context. A lot of us hear this stuff, and there's some posts or some articles that suggest that this would be a catastrophic into the delineation of the Fed and the political system and how terrible this would be. But then a lot of us have lived through like what we would consider to be constant black swan events, right? Like tariffs are going to ruin everything. COVID's going to ruin everything. So it's very hard to gauge like, oh, is, Trump forcing Powell out to get somebody in there who's going to drop rates? Like, is that going to be an obvious, cataclysmic event for markets, or is that going to be a cataclysmic event for how we, view the structure of society? But I'm over here like, yeah, I don't know. I mean, like I'm more in the nothing ever happens camp, you know what I mean? In this regard. So I'm kind of curious, like with regards to Powell, like what do you think is going to happen there? And I don't know, like, do you see rate cuts coming soon? Maybe is the other thing I would add.
Yeah, totally. So I would say what we're seeing right now in terms of this fight to potentially fire Powell and still basically like a political stooge is basically a hyper acceleration of this fiscal dominance idea that I just characterized. It's accelerating what we just talked about, like times 10 effectively. So what does it do mechanically is it effectively starts to move us towards that fiscal dominance world, which means that fiscal policymakers are the ones basically dictating how to stimulate the economy. And the Fed is there basically just subservient to them, basically just to manage the debt load, whether that means, higher fiscal deficits, and then they literally just buy the debt from the Treasury and that sort of thing. So that's one component. Short term, I think we got a hint of this when we got this trial balloon last week, where it seemed like they're on the verge of firing, and then it sort of last minute stopped. And in that moment, it was like the clearest moment where we could see how prices would react to such a situation. And so what happened is that we saw the dollar down, like DXY down 1% pretty quickly. We saw long bonds sell off because people were like, why would I own bonds if we're going to see higher inflation? Probably if you get like a Fed chair that just doesn't care about how hot the economy is and is going to cut rates anyway. And we actually saw equities, like US equities, go down pretty quickly as well. And I think that one threw a lot of people off guard because it makes intuitive sense, especially from like a medium term perspective, for equities to go up because like higher inflation, if we're going to run it hot, you're just like, okay, this is going to be like great for nominal assets like equities. And yes, I think eventually it would, but short term, you would actually get. So if you look at like emerging markets, they've been dealing with this sort of situation for years. There's many examples of this. If you look like Turkey or something like that, where you get capital flight basically. So you get people selling US assets, so equities and bonds. And then when they get the US dollars, they sell the US dollars as well to go into another currency, whether that's gold or like the euro or Bitcoin and that sort of thing. They want to get out of the US financial system. So I think pretty quickly, the biggest like causal effect of that situation would be a major dollar devaluation. So like DIX would go down a lot. And because of that, a lot of that would be capital flight. So I think short term, it'd be really bad for US equities. And then actually during that moment, Bitcoin sold off too. And the reason why I think is that it's still correlated to like US equities, like NASDAQ equities, Max 7 quite a bit. So it would get caught up in that. But I think like this is where we shift from like short term to medium term. Medium term, everything I just described is like why Bitcoin exists and like why gold exists basically. So those would do really well. I just think short term, it would get caught up in those cross currents. But yeah, overall, it's an acceleration of this theme that we've been talking about fiscal dominance. Obviously, there's some hangups like, you know, you can fire the head of the Fed, but the Fed is still like, they decide on interest rates by a committee of 12 people. It's like, it's not just Jerome Powell. So, you know, whoever gets installed as a new Fed chair would have to be like confirmed by the Senate and get through that without them perceiving this new person as just like a political crony. And then they would also have to convince the rest of the committee to cut rates like 300 bips like Trump is asking for. So I think that whole situation just, it increases the risks further. And I think that's super bullish, like Bitcoin and just like alternative digital asset industry that we've created. It would just probably get hung up short-term in correlations and that sort of thing.
Yeah. Okay. This is a bit of a segue now, but because you're talking about sort of flight to different currencies, how much do you ascribe to the belief that stable coins are this like new marginal buyer for our debt? And the reason I ask is because intuitively it sounds correct. Like, okay, now we have, you know, if the entire world has the ability to kind of pivot to stable coins, and stable coins are backed by short-term bills or whatever, that should in theory be great. But with that said, if we start running extremely hot inflation, right? Like it could be one of these things where it's I don't know. Of course, I live in my little fantasy world of hyper Bitcoinization. I'm like, this would be a quick pivot from people wanting to hold stables, right? Because relatively, the US dollar is great versus the Argentine peso. But if the US dollar starts to not be very good, then they'll pivot to Bitcoin. I'm curious, though, do you think that stablecoins can kind of prolong this, I don't know, like long kind of high FTV, low float type dynamic with the US dollar?
Yeah. I live in two different worlds right now on stablecoins. So one, I'm extremely excited about them for a lot of reasons, some of which you just described, which is, yes, like it unlocks one of the fastest growing marginal buyers of US like Treasury bills right now. Like they're not buying bonds, which is kind of the whole issue, is that like nobody wants to own the long-term bonds.
Yeah.
There's plenty of demand for short-term bills, right? Yeah. Like, and this is why you've seen like, so you may have seen in the macro world, like people start to talk about like Yellenomics, like Janet Yellen when she was Treasury, and how like they shifted towards issuing a lot more bills and avoiding at all costs issuing bonds. And like Scott Betson has continued this tradition now. And it's because there's plenty of demand for T-bills out there. They basically have like no duration risk, so they're not nearly as affected by inflation. So plenty of demand there. And then where does that come in for stablecoins is effectively like what stablecoins are. If you just think about it like through a TradFi lens, is they're like a digital version of a money market fund. So people put their money in, and then they basically own an asset that owns a bunch of T-bills and that sort of thing. Now, the only issue, and this is where I get into the other side of like, yes, I'm very excited about stablecoins, but I'm also like cognizant of some of the situations related to them. One of them being that with the Genius Act passed, these stablecoins aren't allowed to pass on yield to the owners of the stablecoins. So basically what happens is that they all have like, they have the T-bills. The T-bills are earning 4.5%. All that revenue goes to the issuer, right? Like Circle and Tether and that sort of thing. And so they're making money like crazy right now because they basically have like a 100% net interest margin where like they don't have to pass on, they can't pass on anything to their asset owners. So that situation is cool and all, but it sort of shafts the owners of the stable coins, and then it makes it like, why would I withdraw my money from money market funds where I'm earning 4.5% to own USDC or USDT where I'm owning nothing? So the demand has to come from something else. And by the way, like that was by design by regulatory policymakers, because they don't want to see withdrawals from the money market funds that exist and like commercial bank deposits. Basically, like they don't want to see that flight yet. They're like banks lobbied super hard, especially like small regional banks. They lobbied super hard against this because they don't want to see all their bank deposits go into stablecoins. So that's the world that we live in. So it's a difficult situation to think about, like, who is going to be the marginal buyers of stablecoins? Obviously, there's crypto degenerates, and that's been a pretty steady bid for stablecoin demand because it's used on perp exchanges and that sort of thing, used on chain and all that stuff, and that's all well and good. But where are the other marginal buyers coming from? And this is where I'm trying to figure this out, right? Is that, okay, is it like emerging markets where, like you mentioned, like the Argentinian currency, which is just like a terrible thing to own because it's so inflationary. So, maybe they just want to own their assets in stable coins and they don't have access to like US money market funds and T-bills and that sort of thing. Yeah. So that makes pretty good intuitive sense. And then also just like, owners of physical US currency in other countries. Like, when you go travel, I remember like I spent a month in Vietnam once, and over there, like, yes, you use the Vietnamese dong, but that thing is so inflated to shit that really, like, if you need to get things done, you use the US dollar effectively, like even with politicians and that sort of thing. So those countries run on US dollars. So I feel like there'll be some pretty good demand there. So putting that all together, I think it's going to be a very positive new marginal buyer for this US debt. But as long as they can't pass on interest to the owners, it's going to be capped to a certain degree effectively. And then maybe that's where some of these more decentralized, like on-chain stablecoins, like what Athena is doing and that sort of stuff starts to come in, where that's where maybe we could get your yield. But the big dog ones are going to be constrained in that respect.
Yeah. And I mean, for that matter, USDT has kind of proven that there is fairly high demand for a stablecoin that doesn't pass on anything, right? So, I mean, they've kind of already shown product market fit there. Okay. How are you trading all this? Do we need to hyper gamble our way out of poverty before the singularity? Like, let's have this. It's like they
before the AI.
The trope now on Twitter, right?
Yeah. I mean, kind of like there's a lot of fundamental basis behind that. Like when we were talking about this whole like fiscal dominance thing, like that is going to make people that don't own assets worse off on a nominal terms, on real terms. It's going to be really bad for them. And then you stack on this other layer, like the AI doomer sort of narrative stuff of, like if you don't own assets soon, you're not going to have a job. It's going to be taken over by ChatGPT and that sort of thing. So there's a lot of headwinds to make a pretty good basis for the argument that like long degeneracy, as that's become the popular trope as well. And I think there's pretty good reasoning behind that, especially in this world of like circling back to how I started this whole journey around just trying to be like a fundamental classic value investor and like doing the right thing, like doing the spreadsheets, doing the DCFs, and then realizing that like in this world where discount rates are just so manipulated, of course, the reflection of that manipulation is going to be hyper gambling on SPACs, on treasury companies, on IPOs, on meme coins, sports betting, all that stuff, right? Because we just entered this world where nothing really is true. Like we've lost price signal, really. Like that's what's happened, and that's what is happening. To the point where it just becomes almost rational to do what we're doing. And I feel like people in the crypto world got to this realization a lot quicker than the TradFi world. We started to see like some themes of this now, where we started to see some people being like, oh, wait, everything is just a grift and a scam and manipulated. And it feels like they're kind of crashing out right now. But like all of us in crypto Twitter have already kind of had that crash out, and now we're just embracing it. We had it much earlier. In fact, the people who were actually trading and weren't, I mean, like the VCs were late to this. It was those of us who were like actually gambling and seeing what people were doing with their money that we came to this realization much earlier. And like most of the people who did well, or also I kind of mentioned this, like the projects that have done well this cycle have tapped into like the most degenerate ways to gamble or trade, whatever you want to call it. But but okay, so then I want to ask, like going off this, like you're looking at the market now,
we can sit here on our high horses, and I'm totally on the high horse as well, to be clear, of, Bitcoin does well in any environment now. Maybe like that's a decent thesis. Does that apply to altcoins as well? Or are we going to need like some rate cuts and enhanced mania that, the economists talk about at the end of sort of like the end of the debt cycle, long run? Do we need that in order to see like a true altcoin mania as well?
No, so I feel like we're in the macro environment that is starting to build up this like degen behavior and environment that we saw like in 2021. Like it's happening right now. The thing is that it's happening in buckets that it wasn't happening last cycle, basically. Yes. So everybody is like praying and hoping that this degeneracy, this froth that is building up is going to lead to people to buy their like overvalued high FTV garbage governance coins. Yeah. And I just don't think that amount of degeneracy is going to overpower the fact that like everybody's figured out the game at this point and nobody wants to buy those coins that are structured in that way. Like you can't convince people. You can't convince people to buy these coins that are just throwing off emissions that have like these 4-year vesting cycles with no claim on any sort of equity or cash flow at this point. Like it's just not there. So I think that's been the big driver behind a lot of the dispersion we've seen over the last year, is the market coming to terms with the fact that like the structure of how we've created these altcoins over the last few years is just not going to work anymore. And we're seeing like coins that try to iterate and innovate on that idea start to be rewarded for that. So obviously the obvious example is Hyperliquid and that whole thing. But yeah, and then now there's like the Treasury company thing, which is just popping off. And I think a big reason why that's popping off is it's a lot easier for a marginal buyer of degeneracy to buy it in their brokerage, which is a quick ticker, than having to go through many hoops just to buy an altcoin that is performing terribly and has this like huge headwind of emissions and VC vesting and all that stuff. So I think it's here, and I think people are just like fighting the last war. The
Gourd Show is sponsored by Elipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Elipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Elipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Elipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers. We kind of established that like there's this like massive, demand for degenerate meme coins on one side, on the ground side, like we've all been, we've all watched these high FTV low float coins. Then there's some, like you were saying, that have been rewarded for attempting to return value in some capacity. What do you think of, like, what is your prognosis for something like Hype? I was going to say Pump. Maybe we'll talk about Pump in like 3 months. I don't know what's going on there, but they make a lot of money, and who knows how sticky it is, but like some of these coins that are attempting to either do buybacks or, share in cash flows of some capacity. Like, do you think maybe those winners will kind of separate themselves, and then we see it like tokens like Hype do quite well going forward, even though it kind of does have like a fundamental value to it, right? Like, what are your thoughts there?
Yeah. I think that's a good way to characterize it, is comparing those two. Because obviously, Hyperliquid has just been the golden goose of this whole experiment. And obviously a lot of that was because there wasn't like VC raises initially. There's no vesting whatsoever, really. A lot of it went to people that were just avid users of it. They were able to create this like call-like phenomenon that allowed people to actually hold their airdrop when it launched. And like, I feel like people have really quickly forgotten the fact that Hype launched at like $2 or whatever and went up to 30 pretty quickly.
Yeah.
it was a very unique situation where people got paid off for that. And so I think they were both like very expertly decided the strategy towards it, but then they also got a bit lucky as well that like the price when the chart got painted and the way it got painted, that it created this dynamic that is, really created some very devout holders. And then it's now been backed up by just this like infinite buyback machine and this lack of VC vesting. So obviously that's like the benchmark now. And so now we're going into this world where we're starting to reflect on how do we go about new token launches, right? Like, do you go as far as saying we're going to launch something with 100, like all tokens unlocked right away? And obviously that's one extreme. And so Pump has started to move a bit more towards that spectrum compared to, obviously maybe not compared to Hype because there was still, VCs in these rounds and that sort of thing. But when you compare it to these dog shit altcoins that we just described of the classic, like high FDV, low float, 4-year vest type idea, we are in a point now where we've seen a launch where there's more token supply right off the bat. Now, obviously, like there's been some issues with that. Is that when you get into this point where you launch this coin and then like you raise $1 billion from VCs right away, and that's like fully vested and unlocked. They like of course, like VC liquid funds have been so starved this cycle. Like of course they're going to take a liquid 60% gain or whatever in size and dump it. Like that makes sense. And so we're in this situation now where you can see in the price of Pump where it's digesting the fact that it's a company that's similar to Hyperliquid, makes money, it's revenue generating, but there's still some hangups in terms of supply coming onto the market. But overall, that supply is a lot larger than these previous iterations of high FDV low float tokens, where we start off right off the bat with a much higher float, and so that's a good thing. But it's probably not a good thing short term, which is what we're seeing now, because basically there's a lot more tokens for people to sell that are in profit. And obviously there's like a little bit of a floor to that because like the raise was at 4 billion or whatever, and we're kind of around that now. But overall, exactly. So it's
how did that happen?
yeah. So but I think overall I'm happy to see iteration happening finally. We have a long way to go. And I think like we will continue to see these like high FDV low float existing governance tokens that have like no iteration around fee generation and pass through to holders. They'll continue to just bleed and die, I think. And I think more and more people will be rewarded for trying to get closer to just this confluence of value that obviously the gold standard being Hyperliquid, but it's not just a straight line to get there. Obviously there's gonna be ups and downs, but I'm pretty positive on the next couple of years. I think we will see a lot more interesting launches like this. And I think that's a good thing. And I think a lot of that is because like, of course, the big reason has been just this regulatory headwind that we've had the last 4 years of Gensler, where like any sort of hint at passing on revenue to owners would just be instantly flagged as a security. So they couldn't really do this. So I don't really blame them entirely. But now we're in this realm where it's like, it's clear we can just be creative with this and we should take advantage of that.
So we talked about how there's this notion like you better hyper gamble your way out or you're going to be eating the bugs, right? Like, and this is just, this is a constant narrative on Twitter. And like you said, unfortunately there is, like as doomer as it sounds, there is some legitimacy behind it. But what I find, and I think you're probably similar in why I ask you to kind of approach this as a trader, is that from my perspective, like, of course I want to tell people like, hey, buy Bitcoin. I think it's a fantastic store of value. And I think, I think this has a future and I think it's still a great asymmetric bet, right? Like I still think the risk reward is like extremely high with Bitcoin. With that said, as well as I do that on crypto Twitter, this is largely falling on deaf ears. Like everybody knows Bitcoin exists. They aren't looking for a 10x over 5 or 10 years. They want 100x's. So in terms of like where if you put yourself in the spot of like the average crypto Twitter participant, like how do you convey, this is how I think you should manage risk. Like this is how much I think you should be gambling versus thinking like putting this aside, taking this out. Like, I don't know. You can go whatever direction you want with this portfolio construction, just clicking buttons, whatever it is. But I'm kind of curious because like I find myself like when I talk to, so it's a bit of a tangent, but like I went to my girlfriend's like sister's wedding a couple weeks ago, and I had boomers approach me and they were like, how do I buy Bitcoin? And I was like, you want me to level with you right now? Buy IBIT and just stick it in your broker. You already have a brokerage account. And they were like, oh, okay. But I'm never going to be able to tell a Zoomer, just go buy Bitcoin, right? Like they're not rich enough yet. That's the reality. So I'm kind of interested like how you approach this, like put yourself as a trader in this spot and like give it to me straight.
Totally. Yeah. So, all right. I think we can take this in two frameworks. There's the one framework, which is you already have your capital base. It's large enough that you can diversify into different things and like still make good money. And so for that, and then the other is like if you're just like starting to build out your capital base, right? Like you're sub 5 figs or whatever and that sort of thing, and just trying to make it to get that buffer to start to be able to like effectively trade and invest. Like it gets so much easier once you have an actual capital base to like risk manage. All right, so the first one, I think like obviously I'm a diversification fanboy. I talk a lot about, so let's just take that framework of the 60-40 portfolio, which we talked about earlier, right? So 60% of that, the stocks probably make sense. The 40% of bonds doesn't make sense for the next 15 years. We described why. So what are you going to do with that? You want to, we talked about gold and Bitcoin. Those make a ton of sense in that regard. So those will probably want to be a portion of your portfolio. I love like owning Bitcoin and gold together because their correlations work so nicely together. And, you know, you can like get into more wonkish stuff of like matching the volatility towards it. So obviously like gold has a lower volatility than Bitcoin. So you could probably have a higher size in gold versus Bitcoin to try to like match the volatility. But I think that's a really good thing to do. And then, you know, we'll ignore alternative stuff like commodities and, you know, private credit and that sort of thing for now, and just focus on the crypto stuff. So you have that baseline. And then I think like I'm a big fan of, I don't know, having like 5 to 10% of your capital base for, you know, speculative degeneracy, running it up style thing. So I think that's a totally fine, like, yeah, like set aside 5%, put it on chain or whatever, and just try to run it up. As long as another 95% is in like pretty reasonable things. And then so the other side of the capital base is obviously that for the people that don't have that base yet, that don't have that like 60-40 2.0 portfolio we just kind of talked about, and you know they're just trying to make it. And I think for their like, yeah, that long degeneracy hyper gambling stuff is all good. I think where people get hung up is just in like a litany of heuristics and bias and emotion that stops them from actually succeeding in this. So I think one of the big things I try to bang the drum on is just like not, you know, if you have $1,000 and you hit 100x, whatever that gets you to, it's too early for math right now. But whatever that gets you to, right? Like take a chunk off and put it into Bitcoin, put it into US equities, put it into something that like actually ends up being real. Because if you just spend enough time on crypto Twitter, you can see that like there's always going to be another 100x coming in the next couple of months. Like there's always those opportunities. The issue is that people either round trip it or they take that 100x and then they take whatever that value is and try to get another 100x with it. Yeah. And then so you get to this point where like, again, like crypto just this like endless opportunities to hit these multi-baggers for sure. The hard part is keeping the money. And so we've seen over the years, like endless amount of, you know, just like crypto Twitter main characters that just, you know, bag hold or double up and try to gamble further. And then they end up, you know, sure they hit 9 figs, but then they're right back to 6 pretty quickly. And so it's sort of simplistic, but it's like, it's really not that hard to make money in crypto. It's really, really hard to keep it on a longer term horizon. So I think just being of the mind of always like sizing effectively. So, you know, if you are that like small, newer capital base and you're trying to make it, like if you don't have to swing for the fences. And if you get close to the fences, just like take some and put it into something that becomes real and just like start stacking your base basically with things that are more real. And then by all means, like keep speculating. Just, if don't always reset with the higher number, like maybe just like withdraw some off from being on chain and put it into a brokerage, that sort of thing. So yeah.
I noticed you tweeted recently that you're off your ETH hater arc, but I noticed you haven't really mentioned Ethereum yet. And I think the reason I ask is because, you're talking about gold and Bitcoin, and a lot of people in the Ethereum community would say that ETH should be included or will eventually be included as a store of value. Why haven't you mentioned ETH yet? Would you just put that strictly into the speculative category? Because it kind of like this 5 to 10%, let's call it, for hyper gambling. I mean, you have to have some pretty massive price targets for ETH in order to consider that hyper gambling, right? It's already at a $400 billion market cap. Like, if you think it's going to 40 trillion, then okay, yeah, you could put that into that 5 to 10%. But outside of that, you kind of want to move farther out on the risk curve. So I'm curious, like, what do you, maybe it started with that tweet, but I'm kind of curious, like, what you think of ETH, the asset right now.
Yeah, first and foremost, I'm a trader, so it falls within that camp for me of a trade. So the reason I was a hater was, just a lot of complacency around some of the meaningful. And I do not have any sort of technical or fundamental edge in crypto blockchain design or anything like that. But just from my basic understandings, there's complacency around like Ethereum Foundation governance and that sort of thing. And it was like acknowledged by them because we've seen that change, right? Like in January, they reset, the executive directors and that sort of thing. So obviously they also respect that there needed to be some changes. There needed to be some changes in terms of like a refocus on L1 scaling, because like this whole L2 roadmap was just a tough situation for value accrual to ETH the token as well. And there's been some meaningful refocus towards L1 scaling. There's been like based rollups and that sort of thing that better attribute value accrual to ETH, which is great. And then, the last bit for me to see that real pivot was just, having these main character treasury companies like Commonly and that sort of thing come forth as well to basically get people excited. It's still a trade for me. It was just underowned, overhated, and was a short leg in like a lot of delta neutral trades for like a lot of liquid funds. So it's just like it created this perfect recipe where it's like a pretty obvious long in that regard. And so like I shifted that from January to June. I could see the ideological shift occur. And that was sort of like ticking check boxes for me. And then once we saw like the price narrative shift as well, that became like the green light to go for it at like around 2,500 or so. So, taking a little bit off the table here, but I still want to slowly shift some of that base that I own towards maybe that longer term portfolio composition. So moving it out of that like 5 to 10% like trading speculation bucket and into something that's a bit more of a longer term hold, because even though like I'm pretty hesitant of these ideas of like ultrasound money and that sort of thing, it still feels like it can sit somewhere in the middle between like, another random L1 and Bitcoin. Maybe it just gets a little bit closer to that spectrum, but it would just need more time to shift to that regard. So I'm not ready for it to be like included in that like super long term, like 20-year time horizon type hold thing. Yeah. But it's making that way back again, which is great to see. I think like when Ethereum does well, like the entire industry does well, which is a good thing.
Yeah, and that's kind of like a good segue to you mentioned treasury companies like Lubin, and then Tom Lee and the ETFs. I think, like from my perspective, so there's two things. One is like the mean reversion, right? Like is the short leg and it was overhated, right? Underowned, whatever. So that's one side of it. I completely agree with. But I also think that like opening up just new sources of capital, this is to me, like what it's shown is that like really all along what ETH needed was just new velocity sinks, like new ways for capital to go into something and be a lot harder or less likely to come out. And this is like the company thesis to me is like, I take it like maybe So we'll talk about, we'll spend the last bit talking about like where you think these blows up and so on and so forth. But I actually think that these treasury companies, both for Bitcoin and ETH and Hype and Sol, like all of these could actually persist for, the well-designed ones could persist for a long time and be a huge long-run source of demand, because this is just idle capital that's going to sit there. And like, that is what you want with these, non-cash flowing assets. You can debate that, but like what you want is people to not sell. This is something that I think I kind of picked up, not to say like this was a particularly revelatory thought, but like I picked up early on, right? And it was like quite a left curve belief is like, oh, what you want, like when you look at meme coins, when you look at Bitcoin, like you want a lot of people, and same with Hype now, who just don't want to sell this, right? And a lot of these treasury companies are really great ways to have people who may not even know they own them, or they stick some money in there and they're just not going to sell it. Like it's great, like their velocity sinks, right? So I'm kind of curious, like what your thoughts are, and we can move into the like treasury company stuff. But I don't know. I think these could be quite important long run for the price, specifically the price, right? Like roadmap stuff put to the side, but for the price of this stuff, I'm like, yo, this is fantastic. Like you want people who just hold this stuff.
Yeah. So I think the right way to think about this is this framework that we all know probably too well in crypto, which is that there's a long laundry list of history of us taking a good thing and extrapolating it to some extreme of like the 100th iteration of it. And even though the first 3 iterations are a really interesting idea, it's the long tail of the 100 iterations that come afterwards that mess with the whole fun that we're having. So I think that's an important framework to have as we get into this. And so it gets us to this point, which is that I think what MicroStrategy is doing is really interesting. I think what, Joseph Lubin with SBET and Tom Lee are doing with Ethereum are really interesting. I think on the Solana side, like what DeFi Development Corp is doing is interesting. And then you start to drift off into the longer tail of, just basically pump and dumps for pipe investors. Really, like it's just there's no iteration happening. There's no innovation happening. It's just taking the 10th. Like it's just like literally going through the like CoinGecko market cap and just saying, oh, that one hasn't been hit yet. Let's launch a treasury company for it, like a Litecoin or whatever, with no real plan or sophisticated executive team executing on this. Like as we've seen with MicroStrategy, when you get into the motions of actually executing on this successfully, it starts to become like pretty complex, like financial engineering, right? Like we're starting to see them launch more of these things. And so you actually do need a team that is pretty effective at understanding financial markets. Like it's not enough to just like spin up a pipe and then, launch it and just issue a bunch of equity at the market as long as we stay above like a premium to NAV. That whole game is not going to be sustainable. So you have to acknowledge, I think you have to acknowledge that part, which is that like 90% of these will eventually trade at a discount to NAV just because they're not really doing anything. And their only lever is just equity issuance. Like a lot of these companies are not going to be able to build up to the point of starting to issue bonds, like convertible bonds and some of the stuff that like MicroStrategy is doing. But I think companies like what SBET is doing and Tom Lee's company will probably pretty easily be able to get to that point of like convertible bond issuance and that sort of thing. So I think overall, I think you're right that these will become the successful, sophisticated ones will become token sinks because they will have ways to basically balance out making sure their premium stays above their NAV because they can go forth and issue these bonds and that sort of thing if their premium, their MNAV is getting a little tapped and getting a little too close. So I think overall, you're right that these will become pretty solid token sinks. And it's especially interesting for the ones like Ethereum and also Solana that have like a staking yield associated with them because you start to at least get like part of a regular cash flow from them. And that's pretty interesting, like from a financial engineering perspective in terms of the yield. So that's all well and good. Now, the last part I'll say on all of this is that you mentioned this idea that these will become long-term holders. I think as we established, these top ones will probably be, but these other ones, if they start to trade to like a discount to MNAV, they will get into a point where it might become their fiduciary obligation to sell underlying assets to buy back the equity, which is a really unfortunate situation to be in. And then they don't become these long-term holders effectively. And like, furthermore, that could get to a point where like you start to get like these event-driven hedge funds that come in and just like get a majority interest in the company, and that's trading at a discount, and just unwind the whole thing, like and then just capture that spread. In which case, that would also be like a selling moment for the underlying asset. So yeah, you kind of have to parse through the ones that are real versus not. I think it's possible that a lot of those ones that end up trading at a discount could be acquired by some of these bigger ones. That's also a possibility, which is reasonable. Yeah.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
It's interesting. I was listening to the guy on one of your co-hosts on Forward Guidance. I think Scrub is his name. Scrub.
Shrub.
He was Shrub. Okay, Shrub. He was. I think it was him. He was talking about MicroStrategy, and I think he came to the conclusion that I've heard other like in the weeds Bitcoiners come to. He came to the exact same conclusion. I'm quite bullish on the notion. I'm not a strategy holder, but like I'm like, yes, this is exactly what other Bitcoiners are saying with regards to MicroStrategy becoming like a financial institution unto itself, a Bitcoin financial institution
becoming a Bitcoin bank. Yeah,
exactly. And I do think that is the long-term goal. But the question I have though is like, when you look at what we can just say strategy first, is there a scenario? I mean, of course there is, but like, is there a scenario in your mind where strategy blows up for some reason? And if so, what causes that?
Yeah. It's like the age-old question. So I will say that like the last time I thought through this for when strategy blew up is before they started to issue a lot of these new offerings like SCRK and like Stretch, which they released like yesterday, whatever, that I haven't looked at yet. So
Stablecoin.
So I'll just say that like my framework for thinking about this is like before I thought about those new ones, and I don't know if there's like tail risk associated there. So let's just set them on the side for a second. But if you just think about the classic framework that they've had for the last few years of, okay, they can issue equity at the market, or they can basically issue convertible bonds. Originally, they're issuing debt basically that had, like the recent convertible bonds are able to be issued with a 0% coupon because of the convertible nature with them, allows it for it to be priced at that basically, because it's still like has this like embedded call option within it. So people don't mind not getting a coupon because it still has that equity like return. That's a different case when you're just issuing like traditional fixed income where, unless it's like going to be changing and maybe like trade as like premium to par or something like that, or like you buy it at a discount to par, maybe you can get some price appreciation in that. But otherwise, it's just about the coupon yield. So obviously the magic has been working for their convertible bonds that they issue at 0% coupon, because that paired with the at the market basically allows them to own a lot of Bitcoin with no real financial obligation to it. Like the covenants associated with it aren't there to make them a forced holder as much as people think. So obviously the one caveat to that is before they got to that point of issuing those 0% coupon bonds, converts, they were starting to issue ones that were like 2 to 3% coupon. And so that like the way they framed it is that interest expense would be covered by the traditional business model that they're running, like a software company. The revenues from that would be able to cover that. So that's all well and good. So obviously that gets me to a point where what are the two main tail risks? It's if they started to issue more debt that had a coupon to the point where the revenues wouldn't be able to match them. Eventually, if they weren't able to pay those interest expenses, they would have to either sell Bitcoin or go bankrupt and that sort of thing. So that's one risk. But overall, like if you just look at the amount of Bitcoin they hold overall, like for them to get to that point, oh my God, like I don't even know what the number would have to be right now for Bitcoin to get to that point. Like 20K maybe? I don't know.
Yeah, exactly.
It's the way they framed it is actually like not quite as levered as people think. So they're in an interesting situation. I don't think the blow up thing is it shouldn't be as big of a concern, I think, as people think.
Yeah, I'm in agreement, but it's also because my bias is that it would be cataclysmic if it did. So I'm just like going to make the assumption that, it'll be okay. But do you expect, going now to these other treasury companies, do you expect SBET and Lubin? Like, the irony is that, so I was talking to Josh from FalconX, and he was talking to me this in terms of the structure of these, and I was really curious, chronologically, how these things come out, and the bankers and the management teams. And I was joking, when you say management teams, you're talking about bull posters. What you're talking about is a guy who can get on CNBC, who can get on Twitter and shill relentlessly. That's what I think of right now when I'm seeing a lot of these come out and they say management team. But what all of this stuff you were talking about just now is complex financial engineering. So I'm curious though, what your opinion. Okay, you see Lubin, right? Lubin is one of the forefathers, one of the long time pillars of the crypto community. He can bull post. I think he can get out there and hopefully bull post. I think Tom Lee can do this as well. Can they create insane financial products that let them continue to run this? That's what I'm curious about. And obviously, as you go down the list, like you were saying with the whole, is this possible because MicroStrategy has a massive lead and they have a lot more complex ability to do financial engineering and stuff.
Yeah. So I think, the way to think about it is that you need management team at these initial launches is basically, a chief bull poster to ensure that their MNAV stays positive, basically. And they need to do that to a point where they build up enough of a base of the underlying asset and just market cap, where then they can start to unlock the bond market and the convertible bonds, et cetera, because then they can start to diversify and have levers that they can pull so that they're not just entirely reliant on at the market equity issuance, which is what 90% of these are at right now. Not many of them have taken the next jump yet. So I think ones like Joseph Lubin's company and Tom Lee will be able to get to that point because they're just such great bull posters. They'll be able to build up that base while getting to that point. But I think the phase one of management team is just bull posting to protect the MNAV as you issue equity. And then it becomes that team of financial engineering experts. And I think that's where the rubber is going to meet the road for a lot of these companies where it's oh shit, now what do we do?
Yeah. I think the last question I want to ask on this, and I also talked to Josh a bit about this, but I mean, in theory, right, the real risk is for some reason these trade at a persistent discount to NAV. And then, right, the notion is that, okay, well, then you sell and you buy back. But what you were talking about with some of these, for example, staking is interesting. And not just staking, but more and more, I think the notion as well, maybe we should put a little in DeFi. Maybe we should start playing some Ponzi games. And I think where there's situations this could definitely blow up is depending on how, and I know this is regulated a bit differently in TradFi, but I'm sure they can still do some things. You get to a situation where they can't even liquidate it, right? In theory, they can't actually sell the coins for some reason, and these are locked up in some complex smart contracts. That to me seems like where there's risk. I mean, and so I wonder, what do you think is the level of, Ponzi games that these guys are going to ultimately be playing with the tokens that in theory should be able to, be sold and buy back the shares, but push comes to shove, who knows where these things are, right?
Oh man, yeah. I'm only just starting to think about some of the implications of when they start to go on chain and start to use some of these funds. I think there was an ETH one that got announced yesterday. I forget what it's called, but I think a bit of their plan is to focus more on DeFi flywheel stuff, which is interesting.
Just
yeah.
So I was just going to say one North Korean hack and it's trading at zero, right?
Yeah, exactly. Yeah. One Lazarus hack or just I don't even know. Just one of these more degenerate lending protocols or something. Yeah. There's just a litany of landmines. So not really sure about that one overall, but I think for sure we can get to this point where the engineering just gets so complex, and maybe that'll go in a good way. Maybe it'll go in a bad way. But too early to tell, I think. But definitely be cognizant of when you see some of these ones that start to do some pretty exotic stuff on chain.
Yeah. Okay. I would finish up with just another question and advice for traders out there. I was thinking, you're talking to the average crypto Twitter participant here. What do you recommend they pay attention to when it comes to all this macro stuff that we're talking about? Like, what are things that, because you're on top of it. I see you posting about stuff every 30 minutes. Like you're very in tune with like the macro landscape. What should I or my fellow sort of degens actually care about, right? Like what are the kind of key markers that when we see something, it's like, oh, this is something to look into because this could influence, trades for us?
Yeah. So by far the most important one is checking to see that we're still within this like fiscal dominance regime that we're in. So I actually got like super bearish in February-ish, leading into Liberation Day. And the reason I was because the talk of the Trump administration was basically to like balance the budget. And basically this like whole Ponzi game that we've been playing the last few years, they wanted to end it. And that climaxed with basically the capitulation after Liberation Day, where they went and they're like, all right, we're taking out the tariffs. We're going to go focus on this big, beautiful bill and pass that thing. And passing this thing is going to actually increase the fiscal deficits. Yeah. So, and then Doge ending. We saw like a pretty big narrative shift from Scott Bessent talking about, instead of trying to go to this like 333 world that he was talking about, like 3% growth, 3 million barrels of oil a day, 3% fiscal deficits, he pivoted towards, we're going to run it hot, basically. Like we're going to outpace the debt by just running the economy hot. So I'm like, all right, cool. Like we have cut the left tail risk of us ending this fiscal dominance Ponzi. We're actually doubling down on it. So it's like, okay, early April, I'm max bullish, and I've been ever since. So basically, keep an eye on whether we remain in that regime. Obviously, the easy way to look at that is just look at like fiscal deficits, percentage of GDP, but then also track like what's going on. Unfortunately, like so much of this is dependent on seeing what the Trump administration is doing, and they change their mind every 5 minutes. So it's very exhausting, but this is literally the most important driver of like why Bitcoin is at all-time highs. So that's by far the most important one. Obviously, the secondary one is what's going to happen with the Fed over the next 12 months in terms of who's going to replace Powell. How much buy-in do they get to be able to meaningfully cut rates like they're hoping to? Even though I think that's secondary to the fiscal side of things, it's still fairly important. And then from there, you get into the more granular stuff like, draws reports, inflation. Like the reason those are important is because they drive monetary decisions. But unfortunately, like the world we're going into right now is one where those become less important. And it's more so about like them, like you hear Trump talking a lot about how the Fed needs to cut rates to manage the interest expense as opposed to managing inflation or unemployment. Yeah. So that's moving towards that fiscal dominance layer. So yeah, like honestly, it all comes down to the fiscal. If they start to get like serious about austerity, get out. But until then, it's like, this is probably going to continue for a while.
Okay. Well, this has been fantastic. Thank you for coming and sharing. I really appreciate it.
Yeah. Thanks, man. Thanks for having me. Really appreciate it.
Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes.